Welcome to another Market Insight Call, where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me today is Chris Ahrens. Chris, how are you doing?
All right, market's down a little bit. Yeah, on the charts, we're looking back at the same time period we've been looking at over the last 4 months. And we look back to that June low. That's that first circle drawn, bottom left. Drawn a black line across. That's that 36.6 on the S&P 500 to show, that we have broken that in the last week. And that is a bad sign, right? You don't want to be breaking the prior lows. Market's trying to put in what would be called a double bottom. Making lower lows, but a technician would say, as long as you're within about 3 to 5% of that low, it will be called a double bottom if we can hold this recovery, which has really only been a 2-day bounce, giving back some of that today. So the charts are looking a little bit weak, but so far holding that second bottom.
Right, and I know my wife, she did marketing, she always couldn't stand when I would say low lows or lower low or a higher high. And what that basically means is that previous low set in, like you said, and then the new low is lower than that previous low. So we got that low low. Tend to be a bearish signal, but still a strong rally out of this, which is optimistic. And that 3,900 or above seems to be a key.
So that's that resistance level I drew. That's a red dotted line, a little bit above 3,900. Shows we've run into some issues there. Market has topped out 2 or 3 times at that level. And we know when the market starts rallying above 3,900, financial conditions get a little bit loose.
Right.
Fed members get a little bit nervous and they come out and they try to talk the market back down. So I do think there's going to be some resistance, pretty strong resistance at that level.
Possible trading range. Keep 3,900 in the back of your mind, because we're going to revisit that number here in a little bit. But you got a chart here for gold compared to the S&P 500. You want to explain how that works and what we see?
It's a relative chart. So it's just going to take gold divided by the S&P 500 total returns. So it's only going to show the trend of one versus the other. This one is gold. So while seeing that it is an uptrend on the year to date, both the S&P and gold can be down.
Right.
So it really just shows direction, and we do see a few different pumps in throughout there. But the last month has been pretty strong for gold. I'm liking the way that the charts are setting up for gold, and the fundamental reasons look pretty good too. The obvious negative is we have 8% backward-looking inflation, and gold is down. Right. So it has not hedged inflation, but it tends to trade with the dollar. Right. So when the dollar is really strong, and it is, you would expect gold to be down.
So that could be an indication of something.
Right.
We're not exactly sure. It could be that inflation. Other currencies are pretty weak. I would also say that it's up relative to the S&P 500 if you've been in it since January. Obviously, if you'd went in March or July, you're not as pleased with that trade because it has been moving. But speaking of other currencies and being weak, why don't we move into what happened to the Bank of England?
Yeah, a lot was going on over there. So if we look at the chart on the left, this is their 30-year bond, right? Their 30-year gilt. And we look back over the last week, and just to frame the entire year, yields have been going up the whole year, right? So yields are going up, prices are going down. That's happening everywhere in the bond market. But we see that big spike last week. So bond yields went from 3.5 to over 5. A very sharp spike in a very short period of time. It was from a couple pension funds. They hedged their liabilities and their assets. Their liabilities are their employees over the long term, long duration liabilities. They need to buy long duration assets. They buy 30-year and can lever up with swaps and derivatives to cause even more duration. And when they start selling, yields go up. They need to post collateral, and that's really what happened. Margin calls. They have to either post collateral, sell something, sell more bonds, go up. If they don't meet collateral, risk management teams are just going to close out your position. Price insensitive. That's the yield spike that we saw last week, until the Bank of England started buying bonds. So their central bank over there, that's the chart that was on the right, showing they bought over 4 billion sterling over the last few days, trying to bring those yields back down because the bond market was breaking.
And so then we got this change in yields, change in dollar, which the dollar's been rising significantly. And a lot of people are saying, well, if the Bank of England is pivoting and they're buying, maybe that's why the market's rallying here, is the Fed is likely to pivot. So what are some thoughts regarding that pivot? And really, the thing is will the Fed actually do the pivot like the Bank of England? And I don't know that's certain. We're going to get that in that here, but you got a comment?
I would expect they would do something like that. If bond yields did spike like that on a one day, our market's a lot bigger than the UK gilt market, so I don't think we'd see yields spiking like that. But certainly if something does break, which is obviously a broad term for a lot of things that can happen when the dollar's this strong and you have all these global markets, I would expect there to be some intervention.
Yeah, and I think the market is expecting that. It's basically, we're in that scenario where bad news is good news again, because it's expecting something to break. But I don't know that you can make that call just yet, because there's a lot of things that are going on geopolitically. Yes, sure, absolutely. Europe is in a lot of trouble, and that contagion can definitely make it back to the U.S., which would cause the Fed to have to change course, do that pivot, and start to become accommodative. But let's look at some of the geopolitics. You had a comment?
I just want to say one thing. As soon as they started buying bonds, right, I messaged you and was like, this, something big's going to happen, right? When the markets love QE.
Yes.
They love a backstop, right? When we saw European markets, UK markets rally 8% since intervention. And so the question was, do you want to participate in that for a bounce from QE, or are the fundamentals there still so poor that we want to remain underweight?
Right, and I think we do want to remain underweight. We'll get into there. There's a lot of structural problems where a rally for Europe is really financialization. There's just more money, so you got yields coming down, as you said. But it's an energy crisis, and that's not going to change the energy. Actually, it could actually exacerbate it, because now you're consuming more energy. And energy is actually probably a decent lead into this slide as, well, what is going on there with the energy crisis? We had the Nord Stream 2 that was sabotaged, attacked. By who? We don't know. We're not going to pretend to have an opinion. You can do all kinds of game theory and play out everyone that did it and those same people on why they wouldn't do it. But the facts are that the pipe is no longer there. It's no longer able to provide energy. So on that geopolitics, well, with that dollar strengthening, and then it's going to have an additional reason to strengthen, is because Europe now has to buy LNG from the U.S. And that means they're going to have to purchase dollars to purchase a lot of energy. So that's favorable for the dollar. Well, the dollar is what all energy is priced in. So then that puts downward pressure on the price of energy. One of the reasons that Russia has done so well, despite all the isolation and all the other policies to try to slow their economy, is because the energy prices have moved up. So they may be selling less energy, but they're getting far more money for that. So that's actually been a tailwind for the Russian economy, having higher prices in energy. Well, if the dollar is appreciating, bringing down the price of energy, and they're now having to buy for the U.S., the Fed may consider geopolitics as a long-term strategy and not want to slow the dollar's appreciation. And in addition, a lot of the strategies that are going with Russia and China, which we'll get into, has been done to try to hurt the reserve status or the reserve currency status of the U.S. This has only solidified the U.S. dollar as the reserve currency. So this strong dollar is hurting Russia because of the price of energy. Now, somebody may say, well, China will purchase additional energy that isn't purchased by the European Union. Well, the strong dollar is also having an effect there. There's basically three legs of a stool whenever you're talking about currency. You can have sovereign policy control, meaning that you get to decide what your interest rate is, whether you're going to increase it or lower it. You can either let your currency free float or peg it to a currency. China definitely pegs to the U.S., and that helps a mercantilist policy for exports. And then you also have capital controls. You can have two of those three. You can't have all three because one of them will break. And for the last 10 years, there's been a trading range, but the yuan has basically been kept in some type of peg to the dollar. And there are certainly some capital controls, but not a lot of capital controls relative to what they could put on. And the sovereign policy, it's not that they have a sovereign policy, it's that their policies have aligned with the U.S. Federal Reserve's policies over the last decade, which is lower for longer. The thing is China needs lower interest rates. Their economy is struggling. Ours may be too, but theirs is struggling more than ours, and they need to lower interest rates. If the Fed doesn't lower interest rates, if they continue to protect the dollar and keep it strong, and China does, one of these three is going to break. Which one, we don't know. There's all kinds of complications on how that capital control could be used to purchase energy from Russia. So we're not saying that there's a clear picture here, but what we are saying is geopolitically there are plenty of reasons why the Fed may say it's worth a recession and it's worth some problems in the market to go ahead and continue to have a very strong dollar policy, especially considering the adversaries of the U.S., China and Russia, would be significantly hurt by that long term. So even though the market is pricing in a Fed pivot, or considering that there is probably a break coming and they're wanting to go long, I would say that's not the trade that you want to put on just yet. And you want to talk about what the market is actually pricing in for interest rates for the Fed.
I know you say they price in Fed pivot, and that really comes on the day-to-day, right? One day, one strong rally, and the whole narrative is Fed's going to pivot. They're going to have to for some reason. But when we look at the actual futures and how they've been trading over the last month, you can see in the lightest column, the lightest white, is expectations from 1 month ago on where the Fed fund rate will end next year, 2023. And they were expecting about 3.25 to 3.75 to be the likely scenario. We're already at 3 to 3.25 now. So that's only a couple raises from where we are now. Well, that's what was expected a month ago, right? The rest of the dark is what's expected now. So much higher. We're expecting over 4.25 to 4.5, completely consistent with what the Fed released in their summary of economic projections a couple weeks ago. So the market's starting to believe now that the Fed, they're no longer pricing in this pivot that there would be a rate cut next year. They're expecting rates to increase and then stay there for the rest of next year. So really increase through the spring and hold.
So it's an increase and then a pause.
Yep.
Not the pivot, not even a pause at this point. So the market is, at least for the futures market, for the Fed rate is saying, no, we think the interest rate is going to be the same.
And then you get few day rallies, like I said, where the narrative changes for the day.
So not so that we come off overly bearish, why don't we talk about some bullish things that we do see?
Yeah, a couple seasonal patterns. They have not held up to this year, but so when we look at the top part, we see midterm average returns in a midterm year, and the yellow is showing, well, October is a really good month. Usually about flat. Obviously, we're not flat this year, down 20, but throughout the rest of the year, seasonally, it is a very good time. Showing the exact same thing on the bottom, just that past bear markets and corrections have ended in October, looking at 1974 and 2002, which were the big ones that then had next quarter returns that were positive. Doesn't always happen. Obviously, in 08, there were negative quarters, and year out from there as well.
And I would say September, October are really crucial months just in the year, because just as much as you can say, especially midterm, there's some good rallies that come out of these months. It could be that one of the reasons there's good rallies is because that's also whenever the markets can take the deepest dive. But to your point, that's usually at the bottom. So that they begin to move out. Let's go to an example of 2008 where we had some negative quarters, but then I guess it's 66 that I confused, but there were strong quarters after that because that became the bottom then in 2008. So we're probably getting close to the bottom, but I wouldn't say that it's time to become aggressive and not. I think there may be another leg down in this. Anything that you want to add?
No, I think you hit it all.
Well, we really appreciate you tuning in. If you enjoyed this, go ahead and hit that like button. If you haven't subscribed yet, hit that subscribe button, and please feel free to share this by hitting that arrow and sending it to your friends. We hope you enjoyed this call, and we will see you in 2 weeks. Thank you.